I see we have a visitor who has just joined us.
Yes, hi.
Who's this?
Oh, Dominic.
Hey, Dominic, welcome back, huh?
Thanks.
Okay, what you have a test when? Tuesday, huh?
Um,
Or your exam rather, your first exam.
yeah, let me see. It's midterm one is the 15th, so I think that's Thursday.
Okay, boy, I tell you,
Yeah, Thursday.
we've already gone
Yeah,
through on chapters 1 to 5, right?
yeah, it's on chapters 1 through 5.
Okay, well, we've gone through all 5 chapters, so we can have another good
Yeah.
review session here. Okay.
Yeah.
We'll wait another couple of minutes. Someone else has joined us. We'll let this person get set up here and find out who the mystery guest is. Hey, who just joined us?
Hello, it's Robert.
Robert. Okay, we got Robert and we got Dominic, and I guess we can start now. My question is, do you have anything in particular that you'd like me to go over with you? Any particular area that's troublesome?
For me, adjusting has been kind of
Adjusting journal
difficult.
entries. What
Yeah.
a surprise. Yeah. Adjusting journal entries are tricky. So let's see what we've prepared for you today. Okay. Adjusting journal entries. Let me get this thing going here. Let me share the screen. Share and share. You should now see the PowerPoint Chipotle.
Yeah.
Okay. If this disappears from the screen, please let me know. We've had just a little bit of a problem with this thing here. I'm gonna make it a little bigger for my eyes. Okay, Robert or Dominic, whoever it was, adjusting journal entries, huh? Adjusting journal entries. Let's get into those. Let's keep in mind that the cycle is during the month you're recording transactions throughout the month, right? You're recording your payroll, you're recording bills to your customers, you're recording invoices you received from your vendors, you're writing journal entries for different things. And then at the end of the month, you print out your trial balance. That trial balance is just a listing of everything in the chart of accounts. It goes in the order of assets, liabilities, equity, revenue, expenses. So at the end of the month, that trial balance may be 100% wrong. We don't know. The only thing the trial balance does for us is tell us that debits equal credits. Let's assume at the end of the month that preliminary trial balance we just printed is 100% correct. It would still be incomplete because we now need to make what are called adjusting journal entries. Adjusting journal entries, a search for unrecorded expenses and revenues, mostly expenses. So these adjusting entries are going to have to be made after we get the preliminary trial balance and adjust to a final trial balance from which we can prepare the financial statements and close and start the cycle. Okay, the accounting cycle. Okay, purpose of adjustments. It's all about accrual accounting. Revenues are recorded when they're earned, and expenses are recorded when they are incurred or experienced, or we got the benefit of them, huh? Adjustments are required at the end of each month to get the revenues and expenses into the right period or the right month. During the month, We used electricity. The month ended, we ran our trial balance, and look at that. We don't see any telephone expense, any electricity expense on the trial balance. Well, that's because we don't even have a bill yet. We're not going to get the bill for another 3 weeks, but we have to record that expense now. That's an example of an adjusting entry, one of the different types of adjusting entries. So let me run through this part a little bit quickly. We've done over this a couple times, but it's really important. When revenue is received at the same time, when cash is received, the same time you do the work, there's no adjusting entry, right? You got paid. We catered a party at the school, and Chipotle's brought some good Mexican food, and we handed the delivery guy a check. Chipotle will debit cash, credit revenue, no adjustment necessary. Here's one of our adjusting entries. Suppose Chipotle's received the cash in advance before they delivered the product. If that's the case, the money they received is not revenue. They can't call that a sale or a revenue or anything. What that creates when they receive that money in advance is a liability. And that liability is called unearned revenue. Chipotle gets the money in advance, they debit cash, they credit unearned revenue. This account here is a liability account. Chipotle doesn't owe us money. The liability is in the delivery of the grub, okay? So yeah, we're going to need an adjusting entry here. We are going to have to get rid of this liability when they deliver the food. So here is a classic. Here is your first adjusting journal entry for unearned revenues. They delivered the food to us. So we are going to debit this liability account called unearned revenue. And now we are putting it into a revenue account. Notice the L here. We're reducing this liability and increasing this revenue. So that's one of the adjusting journal entries we're going to be reviewing. If the money is received after, I'm skipping this because this is a bunch of baloney. The matching principle. When cash is paid on the date, it's the same thing. Now we're talking the expense side. The expense side. We called City College. We called in somebody to repair the copy machine. The person came in. She fixed the copy machine, handed us a bill, and we immediately paid it. We immediately paid the bill. There is no adjusting entry needed, okay? Here is our second of our, I would call 5 types of adjusting journal entries. Here is a prepaid expense. Prepaid expense. My favorite example is insurance. We bought an insurance policy in December, and we paid $12,000 for 1 year's coverage. We did this on December 29th. We don't have coverage on December 29th, 30th, or 31st. The coverage kicks in January. So every month, we have to recognize the usage of this asset. That insurance policy covers us not from the date we paid it, but from when the contract begins, January 1st. So every month, we are going to have to write the following adjusting journal entry. We're going to debit the expense, whatever that prepaid expense might be. It could be prepaid supplies, it could be insurance, it could be rent, it could be taxes, it could be a lot of things. So this adjusting entry is going to be a debit to the expense and a credit to that asset. You're using that asset up at the rate of $1,000 a month. Does anybody have any questions at this point? Am I going too fast, too slow? Just right? Okay. Cash is paid after. I'm skipping this. They're calling this an adjustment. It is absolutely not an adjustment. So now we can really get into the adjusting entries. We have revenues and expenses, huh? Revenues and expenses. Let's start here. The revenues. Two types of revenues really in our course. One we just reviewed, the unearned revenue. You work for the Dodgers. You get my money in the mail. You get my $10,000 for season tickets in 2021. You already got my money. You debit cash and you credit unearned revenue, probably unearned ticket revenue, something like that. And then when the Dodgers start playing baseball next season, every month they're going to debit that unearned revenue account and credit the revenue. The other type of revenues that you might see on your test, accrued revenues. And this is primarily interest income. We loan somebody $100,000 at 12%. So that's $12,000 a year in interest this party owes us. And the deal is they're supposed to pay it at the beginning of the following year. So we loan the money out on December 31st, 19, and throughout 2020, interest has been accruing at so much per month. That entry is going to be a debit to interest receivable and a credit to interest income. And we'll do this 12 times. And at the end of the year, we'll have an interest receivable account that equals the full $12,000 worth of interest, which they'll pay a few days later. And then we've got the expenses. Unearned revenue, prepaids. Have you figured out yet that the unearned revenue and the prepaids are the same thing? The same transaction. It just depends what side of the transaction you are. If you're the one who received the money in advance, you debit cash and credit unearned revenue. If you're the purchasing person, obviously you're going to credit cash and debit prepaid insurance. So each month, we, the purchaser of the policy, is going to recognize $1,000 worth of insurance expense, while the counterpart, the insurance salesman, will do the opposite and record $1,000 worth of income. This is a good grid to look at. Good grid. We just talked a little bit about accruing and some adjusting entries for revenues and expenses. Our adjusting journal entries can also be broken out into these two categories: deferred revenue and deferred expenses, and accrued revenues, accrued expenses. The deferred expenses are your prepaids, your unearned revenue. The deferred items, whether it's revenues or expenses, means this: money has changed hands, but the service is deferred, or the delivery is deferred. A deferred revenue or expense means that money was paid from one party to the other, but neither party has either earned the revenue or gotten the benefit yet of whatever they purchased. And again, my favorite example is your prepaid insurance. One man's prepaid insurance is another woman's unearned revenue, okay? In addition to the deferred category, which is one of two categories, the other category, let's call it what it is, the accrued items. The accrued. In this case here, no money has changed hands yet. No money involved in anything yet. but we have experienced the expense. We have used the telephone all month, but we don't have the telephone bill yet. We have employees who worked the last few days of the month who are not going to be paid probably for another 2 weeks, but the money they earn those last 3 days of the month belong in that particular month and must be accrued. And like we were just saying, the accrued revenues are your interest income. So if you can remember, deferreds, money changed hands. Accrued, there's no money involved at all yet. Under the deferreds, money changed hands, but no service or expense incurred yet. And they're just showing you some examples here. Unearned revenue, prepaids, same exact transaction, right? Depending what side you're on. Okay, maybe they're repeating a little bit, but we do want to understand the adjusting journal entries. Got to hit it pretty hard, right? On the revenue side, adjustments are needed for accrued revenues. Accrued revenues, interest receivable. We loan somebody $1,000 at 10. Give us a better number than that. We loan money at $12,000 at 10%. That is $1,200 per year interest. Anytime you see an interest percentage, that money represents a full year. So if we loan somebody $12,000 for just 3 months, we have to be smart enough to know that 12,000 times 10% is 1,200 per year, or 100 a month, or in this case, we multiply it by 3 to get $300. Unearned revenue, been over that. And the accrual side here, the expense side, we're accruing salaries and rents and things. Let's see what else we got. So that's just an introduction, if you will, to the adjusting journal entries. At this point, we've got now the month has ended. We've run our trial balance and the debits equal the credits, so we have a party. And now we're ready to do the adjusting journal entries, huh? So let's see what they're telling us here, huh? They are telling us something about the property and equipment, because this is another adjusting journal entry. This is the easiest one in terms of learning it, I think, because it's always the same debit and credit. You debit depreciation expense to record depreciation expense, and you credit this contra account called accumulated depreciation. You will never, ever credit the property and equipment. You'll never credit, at this point in the class for a long time, you'll never credit the original cost of a fixed asset. What you will credit is this accumulated depreciation, a contra account, meaning that it is an asset that carries a normal credit balance. It's an outlier, it's an exception. And like all contra accounts, it's married to another account. In this case, it's married to property and equipment. So every month you're going to debit depreciation expense. You're going to credit accumulated depreciation. And what happens is we have 1,270,000 here, and we make our adjustments, and the used cost, they're calling it, let's call it what it is, accumulated depreciation, leaves you with what's called the net book value. Net book value. Let's keep going here. And there is a blank Chipotle. Blank trial balance, huh? We're back on this grid again. You can't look at that enough. So now let's look at some journal entries, huh? Let's look at some journal entries. An unearned revenue. Adjusting journal entry, unearned. was revenue earned that is not yet recorded. Here's a real good example. Gift certificates, gift cards at stores. I love when people give me gift cards. When customers redeem their gift cards, Chipotle fed them. And this particular period, Chipotle has earned $21,300 in restaurant sales revenue that isn't recorded yet. In other words, Chipotle may have sold, let's say, $100,000 in gift cards. This is how much was redeemed during this fiscal period. $21,000 worth of people came in and said, give me my burrito, here's my gift card. At that point, here is your adjusting journal entry. Take a look at it, understand it. You're going to debit unearned revenue and credit the regular revenue. In this case, they're calling them restaurant sales revenue. We're reducing this liability and we're recording this revenue with a credit. And they're just going through some steps here. The unearned revenue account was created when cash was received in the past. And they're giving us a head start. They're saying at the end of the period, there was $33,000, $400 in this unearned revenue account. That was the unadjusted amount. The month ended, and now we know $21,300 of gift cards were redeemed. So we have to reduce this liability here. Maybe it'll help to look at the T account. Compute the amount of the revenue earned. Well, they told us already just now on the prior slide that the balance at the end of the month was $33,400. But our records indicate that customers paid with $21,300 worth of gift cards. Now it becomes revenue. Now it becomes revenue. So we're going to credit the revenue account for 21.3 to increase it. We debit unearned revenues, a liability account, to reduce it. So now our trial balance is adjusted correctly. This preliminary number was wrong, and now we have adjusted it. Unearned revenue. Here, we're talking accrued revenues. And again, we're talking interest income. So investments owned by Chipotle earned $200 for the quarter. Boy, Chipotle's a big company, and they only earn $200. That always makes me chuckle. But anyway, investments owned by Chipotle earned $200 in additional income for the quarter. They haven't gotten the cash yet. Of course they haven't, because the deal is this guy's going to pay at the end of at the beginning of the next period. So Chipotle did earn the $200 during the year. So they have now the obligation to create this adjusting journal entry. You debit interest receivable and you credit interest income. No money has changed hands yet, but we are definitely recording that income. And let's take a look here. Let's look at our debit first. They had no receivable to begin with. That makes sense. They debited $200 worth of interest income, interest receivable, and they credited interest income for $200. They had already recorded $4,700 of other interest income during the month to get that new balance of $4,900. We're okay so far. Any questions? Anybody want to come in with a comment or a wisecrack? Nothing? Going once, going twice. Deferred expenses. Deferred. These are the ones where money was zipping from one to another, but to no avail in terms of recording expenses yet, huh? Supplies. Here is your basic prepaid supply adjusting journal entry. At the end of the quarter, Chipotle counted the supplies on hand. Think of them going back into their restaurants and they added up the straws and the cups and the utensils, the plastic forks. And they said, we've got $10,000 of that stuff on hand at the end of the period. They look at their trial balance. The trial balance said they had 216. Well, that means they used 216,600. They had 216,600 on the trial balance. They went back and they counted 10,000. So therefore, the expense to record is here. You would debit, they're calling it food, beverage, and packaging expense, and you would credit supplies, prepaid supplies. And we know in this course, when we see the word supplies by itself, that's the prepaid asset. That's the prepaid asset. And here they're even giving us a calculation if we really needed it, huh? At the I'll go through this. This will come in handy later, but computation of supplies expense. At the beginning of the period, they had 8,900. Then they bought more straws. So now they were up to 216,600. Subtract the 10, there's your expense. Prepaid expenses. Okay, we just did a prepaid expense there, but let's do another one. Prepaid expense. Well, let's see. At the beginning of the period, they paid $36,000 for rent. That's $6,000 a month. They paid that in advance. Here's your $32,000 insurance policy for a year, and they prepaid some advertising. So all of these three items are now sitting in a prepaid account, an asset account. Here, it looks like the 36,000 was put into an account called occupancy. Insurance would go into insurance expense, advertising to its own account. So was expense incurred? That yes, a portion of the rent and insurance and all the advertising have been used. They're calling all of this one account occupancy expense. Okay. So let's see, a portion of this has been used. They used $46,000 worth. And the way they get, and they don't show the calculation here, but 36 for 6 months of the quarter, that'd be 6,000, 32, 38, I guess, 38 and some of that. But they come up with 46,000. I can't do the calculation in my head, but that's not the key part right now. The key thing to understand is that we have to figure out how much of this was actually used. And they're telling us 46,000. We don't have to calculate it. They're telling us. So we debit I'm sorry, guys, with those happy fingers. We debit the occupancy expense and we credit prepaid expense. Okay? Prepaid expense. You are going to debit an expense and credit that prepaid. And here they're just showing you a little different presentation. When we reduce that asset by 46,000, of course, we debit an expense. And if I may say, of course, one more time, it has the effect of reducing our stockholders' equity. And here they're making us do a little calculation, compute the amount of expense incurred. And here's where they got the 46 that I could not do in my head. Rent was 3 months. 3 months in the quarter. So that's $18,000, 6,000 a month times 3. Insurance, 3 months. They did a calculation. They came up with that. And advertising. Okay. Take a look at your general ledger, your T account, your general ledger. They debited occupancy expense. They credited prepaid expenses. Okay. Prepaid expenses is an asset. We have used $46,000 or we have incurred $46,000 worth of this amount we had at the beginning. Property and equipment. Ooh, property and equipment. You buy equipment, that's not a current asset, that's a fixed asset. And that's asset that's going to last hopefully a number of years and provide us all kinds of benefits. We paid $100,000 for this truck, and over the next 10 years, this truck is going to deliver our product to happy customers all over the area. Okay, that is a fixed asset. It is subject to depreciation expense. We are going to depreciate it. We are going to come up with a number that supposedly represents wear and tear on the machine. The number we come up with really has nothing to do at all with the market value of that truck. And I'll talk a little bit more about that, huh? So every month after we debit this truck, we're going to credit it with this adjusting journal entry. And it's the net book value that goes down. The original cost minus the accumulated depreciation. To keep track of the truck's historical cost that has not been used, that is not subtracted from the asset account. They're just making the point that you never credit the fixed asset. Never. Not until you get a future chapter where there's an exception. Okay? And they're designated contra accounts with an X to help you identify them. I guess that's helpful, huh? So take a look. The debit and credit is always going to be the same. It's always going to be a debit to depreciation expense and a credit to accumulated depreciation. What kind of an account is accumulated depreciation? X, a contra asset. The original cost of the equipment is still the same. The original cost of the truck. What's been reduced, though, is the net book value. Debit depreciation expense, credit accumulated depreciation. And if the life of that truck is, say, 10 years, we're going to write this journal entry 10 times. And at the end of the period, the net book value will be 0. That doesn't mean we throw the truck away. Hopefully that truck will last even another 10 years. It just means it's fully depreciated. Take a look. They gave us the depreciation number, 20,100. You debit depreciation expense. You credit accumulated depreciation. Okay, so this truck is being depreciated over 4 years. This is straight line depreciation. You take the original cost of the vehicle or piece of equipment, divide it by the number of years to get the annual depreciation, which you then may have to express in terms of a month. Okay, so that was a look at some of the deferred items, I think. We just went through the deferreds where money changed hands, but nobody did anything. And they're calling a depreciation expense a deferred as well, okay? Accrued expenses, numerous expenses are incurred without being paid until next month. Salaries expense, utilities, electricity. These accrued expenses accumulate or accrue over time, but are not recognized until the end of the period in an adjusting entry. Keep in mind, when you see the word accrued payable, an accrual is a temporary payable. That's what accrual means. We have figured out what the expense is, and now we're accruing it. We're adding it into our financial statements. So Chipotle's employees earned $13,400 for the last 2 days of the quarter. They worked on March 30th and March 31st, but they're not going to get paid for another couple weeks. But that $13,400 they earned on March 30th and the 31st is clearly a March expense and not an April expense. We have to record this $13,400 in the month where these people worked. We do it as follows. We debit salaries and wages expense, and we credit accrued wages payable. They're saying expenses, that's okay. Accrued wages payable. As soon as you see the word accrued, you know it's a payable. Okay. You've all been out in the workforce. You know, when you work for a company, you work from Monday to Friday. You're not going to get paid on that Friday immediately. You know, you're going to have to wait a week or two. But if the work you did do from that Monday and Friday belongs in that particular fiscal period. And again, they're giving us a nice look at the general ledger. We debit the expense, and now we've got the correct amount of salaries and wages. This 138,600, that represents salaries that they have already recorded and paid to their employees. The only thing they needed to accrue was the unpaid portion, the $13,400. And now they had a balance to begin with of 1,600, and they just increased it by 13,400. The reason you have to accrue this money is legally they owe it to you. You have to record that expense. You have to record this debt, because as I've babbled a couple times when I'm going through this chapter, if you quit on March 31st, they owe you the money. They got to pay you. If they fire you that day, they got to pay you. If they go out of business, they owe you that money that day. You're just a nice employee going along with the company policy. I agree to get paid later. Interest on a note. Chipotle owed $233,200 in notes payable during the quarter. There are two components here. We got principal, the amount you borrowed or loaned, and the interest. Okay? The principal is the exact amount you loaned. In this case here, somebody loaned Chipotle $233,200, and the interest rate is 7.7%. I don't know why they came up with 7.7%, for God's sake. Notes payable was recorded properly when the money was borrowed. We debited cash, Chipotle debited cash, and they credited notes payable for this amount, $233,200. So the principal note never gets adjusted. What gets adjusted is the interest expense. So it's 7.7%. Was interest incurred that is not recorded? Yeah. So they came up with a number here, $4,500, $4,500. So that would be the 233,200 times 0.077, prorated into the appropriate number of months. Don't ask me to do the arithmetic now. But the important point is, look at your adjusting journal entry. Debit interest expense, credit accrued expenses payable. And accrued expenses payable is just that. It's a liability. It's what we owe at that point in time in interest. We're probably not going to pay it for another 9 months. We're going to have to probably write the same entry. I'm assuming this is for 1 quarter. We're going to have to do this every month or every quarter. And then early the following year, we'll pay off this debt. Okay? Just remember, when you see an interest rate on a note or anything else, really, it represents the annual interest rate. Many, many years ago, I'll tell you a silly but true story. I was online at a bank in Rosemead, where I lived for many years. And a woman apparently had a bank account, and it was 5% interest, and it got posted to her book every quarter. And she went in, and she couldn't understand why she didn't get the whole 5% after 3 months. And the poor teller was trying to explain it's 5% a year divided by 4. The lady said, no, it's 5% per quarter. I just wish she was right. Look at our calculation. Oh, I can't see that calculation. I got to move something here. Oh, come on. Let me move this. I'm the only one who can't see the screen, huh? Oh, this is bugging me. All right. Look at our calculation. 233,200 times 0.077, 7.7%. You move the decimal 2 points over to the left and multiply it out. Let me get this going here. And here they're showing you the general ledger again. Showing it to you again. They had 1,600 already in accrued expenses. We had the 13,400, the 4,500. And what goodies do we have next? They're just going to show you another accrual, utilities. The month ends, and we're looking at our trial balance, and there's zero electricity expense, zero gas, zero water, whatever. We knew we used electricity during the period, and we get a bill for 4,000 for usage during the quarter. The bill will be paid next quarter. I don't like where this one's going here. Let's just take it real quick. The organization, let me just read this again. The organizations receive utility bills after utility service, electricity, gas. Chipotle received the bill for 4,400 for use during the quarter. They're going to pay the bill next quarter. Well, that's not really, oh boy, that's not really an accrual account. I don't know. This is not an accrual account. If you get the bill, you debit the expense and you credit accounts payable, not accrued payable. The point they're trying to make, and they're not making it very clearly, is what they should have been saying is we estimate that $4,400 is the amount to accrue. If we have the bill, we don't have to accrue anything. We just record the bill. But they're saying we think we used $4,400 worth of electricity during the month. So we're going to use that estimated number, debit expenses, occupancy expense, they're calling it. It should be called maybe electricity expense, and credit the $4,400. Okay. We feel a little bit good on the accrued expenses. We need to say to ourselves, did we use any of this expense? And if there's no number there, we have to accrue something. Utilities expense is a good example of a typical accrual. You will have to actually estimate the number. There are some estimated numbers on all audited and approved financial statements. It's got to be what's called done on a systematic and rational basis. The boss can't come out to you in accounting and say, look, we had a good month this month. We made $100,000. I don't want to pay taxes on that. So why don't you just estimate $100,000 for electricity expense? Can you do that? No, it has to be systematic and rational. It has to be reasonable, huh? And again, we're looking at the buildup of all these accruals. These accruals are building up. There's our payroll. There's our occupancy. That was the electric, the 4,500, whatever, I forget what that was. And we may have to accrue some income taxes. I don't think you're going to have to do this one, but although it's not terribly difficult. Finally, when we know what our net income is, our pre-tax net income, and that would be our operating income plus and minus non-operating items like interest expense, interest revenue, disposals of a division. We're going to take a look at our net income and simply multiply it by 30% or 20% or whatever the tax rate is. And we're going to record a journal entry for that. So they're estimating 38.9. Their revenues, 645,500. Expenses, this number. That's their pre-tax income. You multiply that by 0.389. I'm sure we all did that in our head just now, right? And we came up with exactly $40,000. So here's another example of an accrual. You debit income tax expense. You credit expenses payable. Income tax expense payable. You may not be paying it for another 9-10 months. But every fiscal period, every month, you've got to come up with this expense because it's a legitimate expense and it has to be on your income statement at month end. Income tax expense, 40,000. Look at all these expenses we're building up now in the accruals. That's a run through on adjusting journal entries to get started here. Does anybody have any questions, any comments to make? I'd like to hear from a couple of you. I'd like to know my audience is still awake. I can sit here all day if you like. Who wants to talk? Nobody wants to talk to the teacher. All right. Hi, Nicole. How you doing?
Good. How are you?
Good. You're the only one I can see. Okay. All right. So you're good with the adjusting journal entries, Nicole? Think you're getting the hang of them?
I think so.
All right. So it's not real easy. You have to just understand that we're on a hunt for missing expenses, missing revenues. Okay. We have now prepared all of our adjusting journal entries, and we've entered them into the general ledger. So now we have an adjusted trial balance. This is the one that's been blessed by everybody in the accounting department and the controller, whoever signs off on them, okay? Now that we have this trial balance completed, we are ready to prepare our income statement. The income statement is drawn from the adjusted trial balance. Refer back to the adjusted trial balance and trace the income statement numbers forward. So let's do that, okay? Let me point out that I always recommend draw a horizontal line here, horizontal line under retained earnings, because everything below that line is your income statement. Let me repeat. Every item below retained earnings represents your income statement. So here's their income, 640, 600 plus that, minus 206. These are your expenses. And here it is translated into your income statement. 640, 600, 206. Where did the income statement come from? It came from the trial balance, starting with your sales revenue. Everything below is your income statement. Everything above is the balance sheet. So once you've done the adjusting journal entries, you've done the hardest part of the closing. You now have a mechanism for doing the 3 or 4 necessary financial statements at month end. Okay, and that mechanism is your adjusted trial balance. So there we go. Here is everything we just reviewed. They had this amount of revenue and then all these expenses. Some of these expenses changed as we adjusted. Remember, we had the depreciation expense, the $2,100 on the truck. We had some occupancy expenses. We add up all our operating expenses and we get income from operations, Income from operations. This means these are the revenues and expenses driven by actually preparing food and running restaurants. These are the items management can be held accountable for. If these numbers don't look good compared to budget or expectations, the bosses can start, yelling at people. How come our packaging expenses were so high? How come we use so many straws? What's going on with you guys? Salaries and wages, why was that so high? And your employees will have some answers here. They'll say, hey, boss, remember some people went on vacation and we had slower working people and we had to work overtime. My point is operations, people are accountable. Down here, nobody's accountable except, maybe the president of the place who approved these investments, okay? Key thing is the income statement comes right from the adjusted trial balance, as does the statement of equity, as does the balance sheet. And I have my little mnemonic. Some people don't like them, some do. Some clowns get silly at night, huh? Some clowns get silly at night. Sales minus cost of goods sold equals gross margin minus selling expenses and admin expenses equals net income. Earnings per share. Metrics, metrics, metrics. Metrics. I'm assuming that you're going to be doing these with the FSAs, and Cornelia is in charge of that part of the course, unless she wants to, push it at me, which would be okay. Earnings per share. You own stock in a company. You own stock in Coca-Cola. At the end of the period, Coca-Cola takes its net income and they divide by the average outstanding shares. So let's see what it was for Chipotle. Chipotle earnings per share, average shares. So they had 31,217 shares outstanding at the per the annual report. And at the prior period, at the beginning they had that, at the ending they had that. They just divided up. Let me clear up my poor use of the English language there. All we're saying is to get the average shares, you're going to take the average shares as of December 31st, year one, plus the outstanding shares December 31st, year two, and divide by 2, which is what they've done here. So their income for the year was $62 million, huh? Not bad. They earned $1.70 per what? Per share. So you as a stockholder could look at that and say, hey, that's $1.73 they now have available to perhaps pay me a dividend, or perhaps throw back into the company for more research or buy better equipment, better supplies. Earnings per share. And in this country here, one of the ways we got ourselves in a little bit of trouble, and I think we still do, is a lot of companies are accused of managing to a short-term number. In other words, the expectation for Chipotle was that they were going to come up with $1.70 per share. And at the end of the month, before they issued the statements, they were only at $1.60. So they went ahead and they desperately, over aggressively, maybe accrued some revenue or something just to meet that number. That's not a good thing to do, possibly long term. Sometimes management thinks short term to what they call hit the number, as opposed to doing what's best long term for the company. A digression. Look at your statement of equity now. Isn't this interesting, huh? When we started in chapter 1, all you had was somebody started a business with some cash, huh? Now we're in more of a corporate situation. So our stockholders' equity section has three elements now: common stock, additional paid-in capital, retained earnings to get the total. Common stock line. Common stock is always a multiple of the outstanding shares. Common stock is always a multiple of the outstanding shares. I'm just going to see if they give us that information here. Real quick. No, they don't. Okay, that's fine. We can work with that. Common stock. Additional paid-in capital, retained earnings. Common stock, it's just the outstanding shares times the par value. Additional paid-in capital is the amount of cash the company received for its stock issue in excess of the par value. So when Chipotle issued stock to the public over the years, the total par value of the shares was $300. So it had a very tiny, tiny par value. And the public said, well, it's worth a lot more than that. We'll give you this amount, plus 300. The par value of a stock has nothing to do with what the stock is worth. It's a required nominal, meaningless number. that various states and entities require on the stock certificate. The important point, though, is your statement of equity is going to be the beginning, these elements here, retained earnings, plus any new stock issue. They issued $100 more, paid in capital, and then any net income they had would go under retained earnings. I just need to move something here. Bear with me, please. There now I can see it. So take a peek here. You started off with 300 here, common stock, additional paid in capital, retained earnings. Let me again punch you with retained earnings. Retained earnings is simply the accumulated income of this company from the day it began, assuming no dividends were paid. In other words, the business begins on day one. There's no retained earnings. At the end of the first year, they had a profit of 1,000. The end of the second year, they had 3,000. Third year, 20,000. The company grew, and those profits eventually grew to 671,500. Okay, but Chipotle paid some dividends. That reduces your capital. That reduces your capital. And that's important to understand. When a company issues a dividend, as soon as they announce the dividend, they're going to debit retained earnings and credit dividends payable. And by debiting retained earnings, they have reduced their capital. So our beginning capital in total was $1,044,000. They issued some stock. They had some nice income, and they were generous enough to give out $3 million in dividends. That is your equity statement. You got to bide your time on this one. I'm always saying bide your time, BIDE, beginning plus income and issuances, D, dividends, ending balance. Bide your time. Again, one of my mnemonics. Let's see what other goodies they have here, huh? Okay, we looked at the income statement. Now we're going to look at the balance sheet. So let me move this thing around here. Remember all kinds of there we go. Balance sheet. Again, you pulled all of these numbers from the balance sheet with one exception. This portion here, your assets, all these numbers came from the appropriate adjusted trial balance. You just copied the numbers down. Easier than falling off a chair, right? At that point, we get to the liabilities and equity. Same thing for the liabilities. You copied everything over. What changed, though, and the only thing that changed, was this equity section here. Because at the beginning of the period, we had this $1,044,000, and at the end, we had $1 million, whatever that number is. And those are the figures that we bring over here. There you go. That was the beginning. That was the ending. They're showing you, they're just showing a couple of years together here. So you prepare your adjusted trial balance, and from that, all you're doing is copying everything over to the income statement. And then once you've got the income, you can bide your time here with a beginning balance plus issuances, and income. D, subtract dividends to get the ending balance. There's our balance sheet. Oh, that's a lovely balance sheet, huh? Closing entries. Students get scared at closing entries. Don't be afraid. This is not that hard if you understand why we are doing these closing entries, okay? Let's go back to our equity statement to explain. You see that income of $62,500? We moved that into equity. Would you agree? Our equity at the beginning for retained earnings was $671. The income was $62,700. We moved it into retained earnings. That's what the closing entries are about. we are going to take the temporary accounts, which are your revenues and expenses. Temporary accounts means the income statement. And at the end of the month, we have to zero out the income statement and move the resulting profit into retained earnings. So what we're going to do is set up all these accounts to zero. So let's take a peek here. Wow, they jumped right into the closing, huh? I don't like this presentation. I'll show you why, but we'll be able to work with it. Let's look at our sales. Sales have a normal credit balance, right? I know you're all nodding in agreement. And we had a gain here. Again, these are credit balances. We have to zero out the sales and this gain. We have to come up with a zero balance. How do we do it? We do it with a debit. So that's why you see a debit to sales and a debit to the gains. We have to do the same thing with all of the expenses. These two expenses here. Expenses have a normal debit balance, lost debit balance. We credit and we credit. And that's what you see up here. Credit for 40, credit for 10. How did we get the 80 for retained earnings? We just plugged it in. We had $130 worth of debits minus $50 of credits. So our retained earnings now goes up by $80. And if you looked at our trial balance now, the sales revenue would be zero. This would be 0, 0, 0, 0. And that's what they should be at the beginning of the fiscal month. We zero them out because we need to move them into equity, which is what we've done here. And I guess they're going to show us an example of a closing entry here. Yeah, they're showing you, what they're showing you here is something I don't particularly like, but it's okay. They're showing you that you can do it all in one journal entry if you like. All in one journal entry. Closing entry. What are we closing? Revenues and expenses. We had two revenue accounts, which we debit. And then we had a pile of expenses, which we zero out with a credit. And when you move all of your revenues over and all of your expenses over, what have you brought over? You've brought over the profit. So we need a number to balance this. Our revenues were higher than our expenses, so we get to credit retained earnings. And now we have closed the temporary accounts. Makes sense? We have a quiet group today, huh? But I'm hoping you get an idea on the closing entries. To me, it's easier to close the revenues into one journal entry and then the expenses in another, but it's up to you. Closing entries, not hard if you understand why we're doing them. We are doing them in order to move the profit into equity. Closing entries. And then the final thing after closing entries, we can now run another trial balance, huh? It's going to be called the post-closing trial balance. After the closing process is complete, all income accounts have a zero balance. Same thing with expenses. We're ready to go into the next month and start recording revenues and expenses again. But for a finite, tiny millisecond of time, we have no revenue and expenses anymore because we moved them into equity. So take a look at your post-closing trial balance. Trial balance goes in the same order, right? Assets, liabilities, equity. What don't you see? You don't see any revenues or expenses because we got rid of them. That profit of $62,700 has now been rolled up here into the 731,200. And now we have a post-closing trial balance. And that's pretty much the last thing you do in terms of what we used to call the closing cycle. End of chapter 4. Did we hit the adjusting journal entries hard enough? I'd like to hear from a couple of people, at least to say hello. Who do I have here? I don't even know who's on the line here. Justin, how you doing, Justin?
I'm good, Professor. So, my thing is everything sounds like really reasonable and I understand it as you go through, but when it comes to the quizzes, where I'm trying to memorize this, I just have a hard time because there's so much out there. Do you have like, I don't know, like a way of trying to lock this down in, or do we?
One thing I might suggest, Justin, is don't worry about memorizing. Try to understand what we're trying to accomplish, and that might help. Like with the adjusting journal entries, what are we doing? We're looking for expenses that haven't been recorded yet, either because we haven't gotten the electric bill yet, or you worked the last week of the month, but you're not getting paid. So if you understand that little part of it there, you're going to debit an expense and credit possibly a liability account, right?
Right. It's just trying to lock down, I guess, those fundamentals.
Say to you, one of the rules I learned a long time ago, when you write a journal entry, you should be able to write a quick explanation for it. And if you can't write a quick, 6-word explanation, it could be wrong. My point being, you can confuse yourself by getting caught up in the weeds. Okay? So there are unrecorded expenses because we haven't gotten the bill yet, or somebody worked and they haven't been paid yet. So you're going to debit the appropriate expense. You're going to debit salaries expense and credit whatever the wages were that last week. And
conceptually makes a lot of sense. I mean,
so you're going to do the same thing with the electric bill or the phone bill or whatever else. Those are called your accrued expenses. The deferred expenses are pretty easy, Justin, if you think about it a little bit. Those are the prepaid expenses. You bought an insurance policy for $12,000, and then that means the first month of that insurance policy, you recognize $1,000 worth of expense. You debit the expense and you credit, in this case, prepaid insurance. Make a little sense?
Yeah. No, I mean, it definitely makes sense. It's just when I get there and we're on a quiz and I'm like, ooh, what's the, does it go here? I know the debit credit, but then anyway, it's just more trial and error. Practice.
No, I feel your pain, and believe me, you're not the only one going through that. Another little tip I might suggest: try to remember that prepaid expenses and unearned revenues are the same thing.
Right. That was interesting when you said that.
Depending on what side of the transaction you're on.
Right. If you're purchasing or selling it. No,
there you go.
That was interesting.
One person's liability is another person's income, right?
Yeah.
Or expense, depending on what you're doing. So.
Yeah.
But
I like it. I mean, it's a puzzle, and so it's fun to play out in my head. But I practice law, and doing accounting is so foreign. It's
You're a lawyer,
like learning. Right? Yeah.
Good Lord.
A public defender. So I'm in Zoom court, and then I'm learning accounting.
You're a public defender.
Yeah.
Oh, what a great! I admire you, public defenders. My goodness. Yeah, you do the grunt work. I was watching one of those silly crime shows last night where a guy murdered somebody and he was clearly guilty, and they were saying to the public defender, "How can you defend the guy?" He said, "That's my job. That's the adversarial system."
Okay. Right.
All right. Well, you hang in there. You know how to find me over. If you need any other questions. Anybody else have any questions? Anything?
Thank you, Professor.
You're welcome.
Bob?
Yeah, who's this?
Hi, this is Suda.
Suda, I can't see you, Suda, but go ahead. Can you?
So I have a quick question because it didn't really mention anything in the reading. On the quiz, does the question in regards to the item 6 selected financial data that you
Uh-huh.
have to calculate out the asset turnover ratio. I'm not sure if there's going to be more question on the item 6 selected financial data. Can you just briefly go over?
Yeah, you want to look at some of the metrics?
Yeah, because I'm not quite sure how to read it completely.
Okay, hold on one second here. What I like to do is call up. Okay, all right, well, let's talk about it. The first one you mentioned was what? The fixed asset turnover, did you say? Which one was that?
Asset turnover ratio.
Yeah, that's gonna be the net income divided by the average fixed assets.
So on the American outfitter that it asked to
You're in your
calculate.
Can I interrupt for a second? You're in your FSA
Yeah.
now, huh?
That's correct.
No, okay, you're in the book. Okay, I'm with you now, Suda. Go ahead again, please. Go ahead.
So it asked to look at the American outfitter financial statement and
Mhm.
calculate out the asset turnover ratio using the item 6 selected financial data. So
Okay.
on the quiz, it didn't really completely explain it. It just give you a hint that's where you should look. So I'm not quite
Okay.
sure if I'm looking at the right thing.
Give me 1 second here. I got the book.
Thank you.
Hey, look what else I just found. Whoop, I better, boy, my boss is gonna kill me. There we go. Being silly, huh? All right, what do we got here? This is appendix. What appendix is this, Suda?
It's just a quiz question. That's why I'm completely lost too.
Yeah, see, what I'm
'Cause
doing
the
is I'm looking for the I have it in the book, the American Apparel, and who's the other one?
I think it's American Outfitter,
Yeah.
right?
Well, while I'm looking here, the yeah, okay, I'm looking at Urban.
Yeah, Urban Outfitter. I believe that was.
Yeah, it would be your income divided by the average fixed assets. And let me just take a look here. I might see. So I guess I don't quite understand the question. I mean, that's how you calculate it. Could you talk a little more, Suda, so I can help you?
I don't remember exactly what the question was asked on the quiz.
Yeah.
So you look at the appendix B for. Let me see if I can look through it because you can't really review your quiz question.
Yeah. Okay.
Let's see on the book. I'm just gonna take a look real quick if you
Okay.
have time.
I just found Urban Outfitters here. Yeah, I said net income before. It's actually net sales divided by the average fixed assets. And
Yeah,
what
it
that's
does give just a few. It's American Eagle Outfitter from the Form 10K annual report.
mm-hmm. Okay, I have American Eagle in front of me here. So all right, all right, we're looking to do the fixed asset turnover, you're telling me, right? So I'm gonna go to American Eagle here. Here's their equity statement. Here's their balance sheet. So if you look at American Eagle, you would add up the property and equipment. That would be that first line item there, the 694 and 856.
What
Now
financial
I might have
statement are you
I
looking
might
at?
have a different edition than you. That might be part of the problem.
Yeah, because
Yeah, but you would take that number there and add it to the prior year and divide by 2. That would be your average fixed
Okay.
assets, and then you would divide that into the sales for that year.
Okay. So you're using the total asset?
I am using just the property and equipment line.
Property and equipment line.
Yeah, they're saying fixed assets. Yeah, when I hear fixed
Okay, it's
assets, yeah,
the
yeah.
707, 797?
Yeah, I would use that line there. And you can tell,
Okay.
and if Cornelia says that's wrong, you tell her I told you that because intangibles, goodwill. You see where it says intangible assets, goodwill. Those are fixed assets. But
Okay.
but when you're talking fixed asset turnover, you're not talking turnover of goodwill, for Pete's sake. So I would just use that one line that says property and equipment, if that answers your question.
Okay. To calculate out the ratio turnover.
That's my story, and I'm sticking to it. Okay.
Okay, thank you.
All right. Anybody else? Question? Anything? Nobody's got nothing, huh? Nobody has anything. Any question, Nicole? Since Nicole's the only one I can see. What do you think, Nicole? Time to end this lesson? You got some comments or anything?
The quiz is different than the exercises that it gives us. I don't know why.
Oh, gee, that's too bad.
No, no, really. But like Justin said, in your lectures.
No,
like,
I know what you're talking about. I
sense.
mean, I hear that all the time. I don't know what to tell you. But if you understand the principles like we're just going through, you should be okay. Just take a deep breath if it's a different look. I mean, if I told you that the insurance expense this month was $2,000, record the adjusting entry, you should know now you're going to debit insurance expense and credit the prepaid, right?
Yeah.
Say that with a bit of uncertainty, huh?
Because it makes sense when you say it, but when
Okay, well, this thing is being recorded, so I guess you can be able to look it up later if you like. But yeah, I don't know what to tell you in terms of the different formats for the questions. But I do hear students say that. I remember I had that. I think students have said that from time immemorial, right? Oh, it doesn't look like it did in the book. Well, yeah, it might be presented a little differently, but it's the same stuff. Yeah, so I'm not quite sure what I can do for you. I would say maybe if you run into that problem, text me or email me, or copy it over to me, and I'll take a look at it, see what the trouble might be. Okay.
Okie dokie.
Other than that, I don't know what to tell you on that one. Okay.
Alrighty.
So we're all set to go, huh? Where's things out of tune, huh? You like doo-wop music? You get the idea. Okay, everybody, that's the end of our lesson. And I have to trim a certain amount of it, so we'll get it out later, okay?
Great.
Thank you.
Professor. Thank you. Thank you.
Okay, good night, everybody.
Thank you.
Bye-bye.
Thank
Bye-bye.
you.